The Consumer Price Index, or CPI, is the single most important inflation gauge for Forex traders. It measures the average change in prices that urban consumers pay for a basket of goods and services. When this number comes out hot or cold, it moves markets instantly because it dictates the next move from central banks. If the CPI report shows inflation rising faster than expected, the market immediately prices in a higher probability of interest rate hikes. Higher interest rates attract foreign capital seeking better yields, which drives demand for that currency. This is why a high CPI reading is typically bullish. It suggests the currency will strengthen as rates go up. Conversely, a lower than expected CPI reading signals that inflation is cooling off. This gives central banks the ammunition to pause or even cut rates. When rate cuts are on the table, the currency loses its yield advantage and investors look elsewhere. A low CPI print is generally bearish for the currency in question. The trick is not just the headline number, but the core CPI and the market's expectations. A 0.2% increase might be bullish if the market expected 0.1%, but it could be bearish if the forecast was for 0.3%. You have to compare the actual data to the forecast to understand the directional bias. You also need to watch the currency pair's reaction in the first few minutes. The initial spike often gets faded by institutional algorithms. Unless the data is a massive surprise, look for the retracement and a second move. The real trend usually establishes itself about 15 to 30 minutes after the release. This is a pure news trade, so you need a rock-solid execution plan. Set your alerts for the release time, know your support and resistance levels beforehand, and never chase a breakout that has already run 50 pips. The volatility is extreme, and slippage is common on the open. If you are trading the dollar, keep an eye on the reaction in bond yields simultaneously. If yields are spiking alongside the CPI, the dollar will rally. If yields fall despite a hot CPI, something else is driving the market, and you should stay flat until you understand the divergence. Ultimately, trading CPI is about risk management and conviction. Take your profit targets quickly because the volatility can reverse just as fast as it started. One good CPI trade can make your week, but one bad one can blow your account if you overleverage. Respect the data, trade the expectation, and book your profit before the next headline hits.